charges, which basically negatively impact narrow product lines like a monoline like P&I, insurers that also tend to have a longer-tailed reserve line, which is also the case for P&I mutuals. The club issued a circular at that time when it happened, 0424. I'm sure that many of you read it, laying out its position in this respect. And we did question the fair applicability of the revised model to assessable mutuals, given the nature and the structure of P&I clubs as compared to your standard commercial insurer, which that model is really meant to rate. We are, of course, cognizant of the world that we live in, and that we operate in. But I will say that we do anticipate, as the club's technical position within their revised model develops, we do look forward to an upgrade within the next year. Notwithstanding the S&P development, I would like to say that we are very, very grateful and cognizant and thankful for the support that we received from the broking community. Many of you right here in this room and in the rest of the building, and some of you vocal about it. Also from our members that are in this room and have really, really supported us through the years, and the market in general. So basically what I want to say is thank you first before we get on to the statistics and to the performance indicators. So let's begin. The slides that we're going to start seeing will be reflecting where we've been, where we're going, where we stand. So this slide is I can see it right here, the weighted tonnage and net premium by domicile and vessel type. You will see that the majority comes from Europe, Middle East, and Africa from a domicile perspective. Most of it is from right here in Greece, and that makes sense given the ship management position of this market in the world. The balance is almost then evenly divided between the Americas and Asia, slightly higher in Asia, given the regional risk assessment perspective, as well as the relative positions of the regional operating fleets in the world and the types of trade that they do. Excuse me. From a vessel type perspective, the club is weighted more in bulkers. It's also the traditional majority sector that the club tends to underwrite, trailed quite closely by tankers, with general cargo, passenger, and ro-ro next in volume, followed then by the smaller tug and barge and small craft trading, but those within the jurisdictions that require jurisdictions that require high liability requirements. So the comment I want to make about this and what this reflects is it reflects our approach to risk assessment, because risk assessment plays a significant role in the makeup of tonnage and premium. The process that we use is a dynamic process, and it's systematically reviewed from multiple factor perspectives, and it's also informed by actuarial data-driven models for specific vessel and region risk categories. Now, moving on to one of the most important aspects of the club's development, and that is the development of claims, but this also includes reinsurance expense. So this chart includes all net projected ultimate exposures for claims on the mutual, including contributions to other clubs' pool claims, and the reinsurance cost. It's net of the reinsurance recovery so that you get an actual picture of the net result. It is also inclusive of IBNR. 2024, I want you to note, those shows the earned position through September 30th. We want you to get a full picture of all losses, direct, assumed, loss adjustment expenses, and cost of reinsurance that necessarily goes in to manage all of this. So you're going to see, and it tells a very interesting picture. It reinforces what we've been saying over the last few years. You'll see from the graph that the overall development reflects a continuation of an elevated claims and reinsurance environment, which crept up from 2016 and then matured into what we call a new risk landscape, which we really believe started in 19, was tempered by stagnant trade in 2020 due to the pandemic, and then continued on upward after to stabilize at a generally heightened level since 2021. During the past year, as we all know, geopolitics and inflation have remained a dominant factor in global shipping, impacting the claims costs, both from the actual values of the claims as well as from an operational perspective. In fact, I don't know if many of you know, but there was a report published by Kennedy's law firm last year that analyzed claims inflation in particular for 11 jurisdictions. It identified a growing trend of overall excess claims inflation worldwide. Third-party litigation funding was identified in 7 of the 11 jurisdictions analyzed, and overall public sentiment of an increased appetite for litigation and claims was identified in 10 of the 11 jurisdictions. So what do we do about that? Well, at the American Club, we've implemented various strategies to mitigate the explosive exposure that this brings. So what we've done is, through these measures, and I'm going to be speaking about them a little bit later, is we've brought the average cost of people claims down by just under 40% in 2023 compared to 2021. But we experienced an upward trend in frequency by about 35% for the same period. And that kind of tells you the picture that while in some areas you tend to mitigate exposure, you still have the volatility of frequency and of other aspects of claims and operational costs. Furthermore, we experienced an increase in average cost of third-party property damage and FFO claims by 25% for that same period, so from 21 to 23, while in that case, frequency remains stable. However, in 2024, you've probably heard also from other clubs, you will have seen it in our last circular, we have experienced what we consider is greater individual severity of large claims in that category, and that happened early on in the policy year. So what do we do about this? So in addition, we conducted a deep dive into all claims within our retention in excess of $500,000. When I say within our retention, that means up to the pool excess, which starts at $10 million. So all open policy years, we analyzed all claims above $500,000 to $10 million. So while we didn't find a particular or specific distinguishing link between all of these claims, what we have found in general, not surprisingly, is that human error in one form or another, whether in navigation or a contributing factor in mechanical failure or in cargo operations, make up half of those large losses. And we at the American Club believe that human factor is key. We've been saying this for a number of years, and we've invested much time, effort, and resources into loss prevention campaigns, such as the PME program, mental health guidance. Recently, we also did something related to sexual assault and sexual harassment on board, which many of those things, if you take the time to go look at those narratives, at those animations, apply equally ashore. E-learning tools, pamphlets, guidance, videos, most recently the Good Catch initiative series, so that we can try and relay the lessons that we learned through our claims and through the near misses that our own members experience. So we remain committed to this cause. But the reality is that it is an industry-wide crisis, and it's going to require many more stakeholders to address this efficiently and effectively. So from a marine insurance perspective, we're going to continue our campaigns, but ultimately our key risk assessment tool is rate and terms alignment based on the particular type of ship, vessel, trade, sector, risk category. Moving on to pool claims, which have been of interest this year, especially early on in the year. So the blue bar tracks the position of the club's contribution to other clubs' pool based on the actual incurred and reserved. The red line tracks those same costs, but adding on the IBNR. So basically, it's giving you the picture where we think it's going to end up based on our actuarial analysis internally of our data and our experience over the years. So the more moderate pool claims experience of the recent past was disrupted early in 2024. And that places the projection for 24 at levels similar to 2019 and 20. And you will note that the blue bar, which is the actual incurred and reserved for 2024, right now is at the same level at the 8-month mark, equal to the 2023 policy year, which is now at the 20-month mark. And that is what informs us in terms of understanding the ultimate projection. We can get lucky. We can have a totally benign year for the rest of the policy year, and that's what we will all keep our fingers crossed. But experience tells us that this is potentially where it can land. So this also reflects what we said earlier, the experience that we're having with the high severity of individual large claims early on in the year. Investment performance. Luckily, there's only one red bar there. So investment performance has generally been positive the last 2 years, with 2023 bouncing back to 8% from the negative 10% of 2022. As of November 2024, we are at 4.6%, falling in line with our historical average return based on our tested investment allocation model, producing returns generally just over 4%. The investment allocation strategy is naturally a conservative one, as the club is subject to stringent New York State regulatory oversight, but the board, some of them right here in this room, follow that very closely. And so also I'd like people to understand that from a fiduciary prudence perspective, the policy year budgeting, so when we decide on the targets that we're going to do in terms of premium alignments, they are calculated without taking into account the potential investment returns. Okay, so we're going to move on to EOM, Eagle Ocean Marine, the club's fixed P&I cover. This is a cover that's focused on smaller regional trading vessels that don't necessarily need the high liability covers that the mutual club offers. And we're very happy to note that we do have a lot of our EOM insureds in the audience here today. On this slide, we see a breakdown of tonnage by domicile and vessel type. The majority of tonnage is managed in Asia, with a slow-growing constituency in Europe with the recent expansion that we've done through the European subsidiary in this sector of P&I. You'll note on the vessel type, we have a pretty good balance between the three sectors of dry cargo, having the majority though, closely followed by small craft, and lastly, small regionally trading tankers. You should all know that these vessels are subject to very high due diligence processes as well as very strict survey requirements. Again, these images and the percentages are done through a weighted tonnage premium calculation so that you can get the big picture. And in addition, I think it's important to note that the risk appetite from a sector perspective on the fixed book is driven by high caution, sometimes aversion to passenger and container tonnage. And that's just because of the type of risk category that it is and the fixed nature of the facility. So the EOM net loss ratio, it does look a bit volatile. Okay, so this measures the net loss ratio from 2011 to date. 2011 is when we actually started the facility. So EOM was not immune to the same disruption that impacted the mutual in 21-22, in particular, both with respect to the claims elevations trend as well as a reinsurance readjustment. And just as for the mutual, on the fixed, we conducted a detailed actuarial analysis of the insured portfolio as well as very detailed individualized review account by account and implemented modifications to the underwriting parameters and the terms that apply to Eagle Ocean Marine. We identified specific trends of elevated claims from certain profiles, and we adapted the model. Measures were implemented leading to specific developing trends being arrested, and so despite the spikes, you see as a result, the net loss ratio is now trending downwards. So let's talk a little bit about the risk assessment approach. It's a dynamic process, and we've always approached our underwriting risk assessment process within the context of a dynamic, adaptive, data, intelligence-driven strategy customized to the constituency. And some of the features of this process include, so in addition to our own in-house actuarial analysis, we continue to receive input from an outside independent actuary to provide analysis in real time of our underwriting results. And that assists us in our rate modeling and profile appetite on both the fixed and the mutual. And that has actually led to an adaptation of the risk, the vessel type risk, but it's now done in real time because it's done on such a frequent basis that we are actually able to dynamically adapt the model as we go during the year. In addition to the evolving target vessel and management profile strategy, in 22 and 23, we non-renewed a number of poor performing accounts and applied corrective measures to some others. So we have a lower tolerance for repeating high combined loss ratio performers, and that now remains a standard feature within our underwriting review every year. In addition, we further enhanced our initial inquiry, ongoing, and renewal due diligence processes. Some of you have experienced that, I am sure. And further integrated this intelligence-based factor into our appetite, our risk appetite approach. So using the data-driven model, the method, which provides a deep dive into ship-specific data, operational data, geographic, trading, and regional risk factors, as well as, we can't forget, market and regulatory changes and trends, we have been steadily and dynamically adapting the underwriting strategy to align with premium, deductibles, and conditions of entry with the risk categories. In addition to that, we added a quality control measure to ensure that all vessels eligible for renewal at the time of renewal remain within our risk appetite on both the mutual and on the fixed. So that means that we may have an account with vessels that have been with us for many, many years and are running quite well. They are reviewed and analyzed as if they're being presented for the first time at renewal. We enhanced the vessel survey program. We reduced the time frames allowed for compliance, and we added also an individualized management approach. So in some instances, in cooperation with the members, we implemented an interactive management audit, which not only encompassed a survey and an audit on board, but also ashore. And then finally, systems enhancements are continuous, because that always leads to better internal intelligence when managing and assessing new inquiry approaches. So you'll see we've been quite busy. And this is the picture that comes about from all of these measures that we've taken. And I think this is a very telling picture. So here on this slide, the blue line tracks the combined loss ratio since 2018. And it excludes the effect of supplementary calls. So it's a true combined loss ratio analysis. On the red line, we track the cumulative premium growth from a percentage perspective since the same period. And then the green line, we track the cumulative tonnage growth for the same period. So what do we see here? We see that the high combined loss ratio trend was arrested with a break-even result, turning now into a surplus position for 2023, because as you'll see, it's, this slide is wrong. This is an old slide. So this one for 2023 should be here. We used the wrong slide on here, so we'll have to fix that. All right, that should actually be right there. It's actually at 98% now. Sorry about that. Okay, I'm glad I looked at it. And while the premium growth is up by 44% since 2018, and tonnage growth is up by 15% since 2018. So, what does that tell us? Wrong page. This reflects a continuing development of premium that is going ahead of tonnage. So you'll recall back in slide 3 that 21, 22, and 23 have all developed around the same levels in terms of claims and related cost exposure. Despite this, you see the combined loss ratios have been constantly improving. So how does that happen? That happens because the dynamic risk adaptation process, which informs the underwriting profile, but most importantly, informs rate alignment, is what makes the difference. In fact, I don't know if some of you are aware of this article. AM Best, in an article earlier in the year, referred to last year being the first year of general underwriting profit within the group since 2016. This, despite the fact that the overall claims levels were greater across the board last year as compared with 16-17. So again, what does that mean? The only differentiating factor is the volume of premium. And in that respect, we are obviously very happy to report that 2023 is now better than break even. And as a result, you will have seen from our last circular, we reduced the release call margin for that year. On 2024, naturally, it's very early to tell. But as we reported in the circular, and in line with what many other clubs are seeing, we've experienced, like I said, a higher severity in claims values early on in the policy year, not on the attritional level, which is reflected in the uptick. But really, if you think about it from a visual perspective, with 2023 at that point basically break even, in any event, that would be almost an almost impossible thing to maintain so close. So it's natural that you're going to see a slight uptick in any event between 2023 and 2024. So it's apparent that the adaptive measures that we've taken over the years are now manifesting positively. The combined loss ratio has steadily dropped, while premium continues to outpace tonnage. And that reinforces our position that it's a constant review that's done in stages of the risk portfolio, combined with a steady adjustment for premium alignment with the modern world of the claims environment that we live in, that is key. And let's not forget that from 2010 to 2018, we saw rates fall overall by about 40% across the board in the P&I industry. Furthermore, not on this slide, but very telling, is we've improved our renewing fleet underwriting loss ratio. So post-2022, it was 63%. Post-2023, it was 53%. And despite the challenges of the 2024 renewal, it is 51%. And this is a strong indicator, we believe, of performance going forward. So we're approaching 2025 with greater premium aligned to what we refer as this evolving risk landscape, which has resulted in a relative leveling of claims over time. But as volatility persists, and we've seen that especially on the pool level, and people claims, along with the value of large casualties continuing to rise, in order to ensure a continuing alignment, and as reported in the recent circular, an overall 7% targeted increase was judged by the board as needed to ensure better than break even over time, given the long tail of liability claims. Last year, we talked about our commitments, and we're going to continue to talk about our commitments. So adaptation to changing risk landscape can only take place over time and in stages, and that's exactly what we have done and what we are committed to doing as the risk environment evolves. The club represents a significant and important voice in the industry and in the IG. Small to medium-sized operators, the majority of which hold traditional family heritage in shipping, many of you here with us today. We are committed to this sector. We have and will continue to ensure that it has a voice and that it is heard. We're committed to our membership whose loyalty is highly valued, but also individual performance is always rewarded in the long term over time. We're committed to the dynamic approach of risk assessment to ensure that we can absorb the existing and the emerging risk within a healthy premium rate alignment strategy and ensure stability over the long term. We have also always maintained an ethos of being the solutions provider, both from a commercial problem-solving perspective as well as from a cover perspective. We think outside the box, and we don't look for the loophole. We always try and bring the member into the rules. We try not to shut them out, and we are committed to ensuring that this remains a priority. We're also committed to guiding our members as the world changes, whether from a regulatory or claims perspective, and we will continue to invest time and energy and resources in our loss prevention and in our compliance and regulatory guidance that we know is so crucial to be able to navigate the storms that our members go through today. We're also committed to our broker community. Many of you here today, we understand that you are a key part of the P&I ecosystem. Ultimately, we have also always seen ourselves as an extension of the operations of our members. We're part of a larger shipping sector family, and as a small club, we have the privilege of actually knowing almost all of you across all of our regions through our offices, and we remain committed to these relationships with our members. Finally, It's actually not finally, there's a little bit more after this. We continue to be absolutely committed to transparency on all levels, in all of our dealings, in all of our communications, all of our reports, and we're committed to keeping our ears to the ground and open to feedback and to adapting to the needs of the membership. The metrics today show that our commitments have made a difference. Now, before we move on a little bit, there's a few more things we want to talk about. I don't know, many of you me during the last Posidonia, I had to leave because I lost my grandmother. I mention this because my grandmother was very interested in politics when I was growing up and even up to the end. And one of her dreams was that I become the first woman president of the United States. Well, you know, given the last election, we still have time. But obviously, I guess many of you heard that we did have an election last month in the United States, right? And so a lot is being said about that. But we have firsthand insight to that. And here to unpack the election and the impact on global shipping is our COO, Daniel Tadros.
Καλησπέρα και καλώς ορίσατε. Now that you've heard all the good news from Dorothea, it's left to me to address some other fun facts. And I'm going to put this up so you can enjoy, while I preface it by saying this. As the only P&I club in North and South America, we feel we're in a unique position to offer our perspective on what goes on with politics in the United States and what the impact may be to shipping in general and to the P&I world. But in order for me to start this breakdown, we need to unpack a few very key facts. One main difference between this election and the last time there was a Trump administration is that when President Trump will take over in January of 2025, he will have complete control of the White House, the Senate, and Congress. And what does that mean? At least for the first 2 years of his presidency, he will get a lot more passed than he did the last time around. And many of you believe, as I do, that President Trump is very unpredictable. But in many ways, he's also very predictable. And I think that's the key for all of us to focus on. His cabinet is already almost completely full. This time around, though, he's gone about it in a totally different way. Yes, many of the individuals he has selected are conservatives. But if you've been paying attention to the news, many of the individuals that he selected are also commercial people. They're businessmen and ladies. That's very important going forward. And many of you are probably sitting there going, yeah, but he never listens to his advisors. In his first presidency, maybe so. But in this one, I personally believe that he'll be listening a little bit more. He's learned. So what does this also mean for clubs in general and for shipping? Another very important fact. Not only is there control by the Republicans of the White House and the Senate and the Congress, but also governorships and state assemblies. Why is that important? As many of you know, part of the social inflation that Dorothea addressed comes from the United States, but it's a universal phenomenon. It's all over the world. Focusing, though, on the United States, when you have conservative governments and conservative assemblies, that may translate into tort reform. And why is that important for shipping and P&I clubs? Because the next time a seaman or a stevedore hurts his pinky, it won't cost $11 million to give him in damages. We're hoping that we're going to see some changes with tort reform. Now, one of the things about President Trump, as you all know, is he loves to tweet. And he loves to poke bears all over the world. And I believe he does that for a reason. I believe he sends out messages. One of those, as many of you have heard, are the tariffs, right? And the media, and many of you are here, and I'm going to say something I said when we were in London a few days ago. I appreciate the media being here, but please don't quote me. Don't be like Trade Winds and quote me the very next day. So the tariffs, why are they important? If you recall, in his campaign, he talked about 100% tariffs, or at least 60%. Just a few days ago, he tweeted that as far as China, Mexico, and Canada are concerned, those are his main targets. He's already dropped to 10% for China, 25% for Canada and Mexico. So that's where some of the unpredictability and predictability come in. Now, what does this mean for shipping? The media is in a frenzy, and a lot of pundits in the United States and maybe elsewhere, oh my God, this is going to destroy shipping. It's going to be a detriment. Well, if you look deeply into the statistics, bulkers and tankers should not be impacted. The trade that possibly will be impacted is containers. Okay? Because what he's trying to do with his tariffs, he doesn't want finished products in the United States. He wants raw materials. He wants the United States to build their own finished products. And where are those finished products coming from primarily? China. And where do they come in? Containers. Well, bulkers, tankers, all that will continue. Now, what will change, we believe what will change, is that there's going to have to be a trade adjustment, a trade route adjustment. And what do I mean about that? The volumes of trade will change, routes will change. For an example, let's just say that the tariffs against China result in China issuing tariffs against U.S. grain. Okay, so the grain routes will change. They'll be coming from Brazil to China as opposed to the United States. That's what I mean, trade routes will change. The same with the tanker market. We believe it will be a positive impact. Trade routes will have to pivot. Okay? Now, the bottom line for our members, and I believe shipping in general, is you just have to be more agile. And you have to be in tune with the daily events. As I go through all of this, I'm going to switch a little bit from tariffs to sanctions. What is the expectation? Don't hold me to this, but I truly believe that in the next year, Trump will play a significant role in the end of the Russia-Ukraine war. I think those tariffs are going to go away, and he's going to do what he did in 2016. His main focus is going to be terrorism, Iran, and the countries that are associated with Iranian-backed terrorism, and of course, Venezuela and Cuba. Now, Russia is going to be tricky, because if that doesn't end quickly, there may be a conflict between U.S. sanctions, which I believe under Trump will be lessened, and European and UK sanctions, which I don't think will be lessened. And that will be something for all of us to watch in the coming months. So, there are two keys. If you leave with something today from this presentation, there are two keys to keep in mind for shipping. Strategic agility, and number two, concentrated focus on developments daily and weekly. And yes, President Trump is unpredictable, but he is decisive and aggressive. And this is what I'm going to leave you with, aggressive. What do I mean by that? His Justice Department will go after companies, vessels, with a lot more vengeance than the Justice Department and OFAC did under Biden's administration. So, if the focus of sanctions shifts to Iran and Venezuela and Cuba, my message to everybody is, and I was quoted on this, don't be loosey-goosey with your compliance. Follow that, because this time around, you may not get away with it. And that applies to owners, charterers, and P&I clubs. So, I hope this was a bit enlightening, hopefully a little bit of better news, bad news. And Dorothea, why don't you come on up?
Mina. Thank you. I think we can all agree that was very enlightening, and hopefully provided some guidance. So we do have one more commitment that we didn't talk about earlier, and that's the commitment to our people. And so I'm going to go through a very long list of people across the board, and I would like all of them that are present to come up and join us here at the front of this room so that you can see how much how greatly dedicated we are to this region. So obviously we have Dan here, and now I would like to call up Joanna Kukuli, who runs the Greek office. We've got Andrew Dyer. Adonis Babas is not with us, unfortunately, today. Marivi Banu, Chrysanthi Paplomata, Katerina Stavrakaiki. We have a few more that are not here. Maria Ariola Mariana, George Papadiamadis, Nefeli Maratu. We have a few new faces you probably have not seen before. Venetia Theoharidi, Nicholas Apostolou, Stavrula Leondara, Victoria Padaris, Haris Tiboglu. Kostas Dounis is not with us. He's actually serving the country. Epaminondas Anastasiathis, Eleni Jimmy, Sophie Karabournis, Petrina Kalambokidi, Annie Papadimitriou. Then we have Martin Cook from the UK. And then we have our partners from HMA. We have Elias Tsakiris, Elias Bobolos, Vangelis Gakos, Elena Zuma. No, you have to get up. You have to get up. Nikos Balaskas, Navsika Chrysikaki, Ioanna Skondra, Mariana Angelopoulou, Kyriakos Psiris, Yannis Psycholios, Lina Stavraka, Olia Papoutsi, Angelos Tapinos. We also have with us board members Maria Christina Chtistaiki, Katerina Helioti, Ioannis Kefalas. I thought I saw him. Okay. And then we also have chairman of the club in Europe, Vince Solarino, to come up and join us. I don't think I forgot anybody. Can we all get over here, get on this side for a photo? Or can we come over here? Can you sit? Can you get a photo?